What happened? Obviously, inflation was a big component of this, but why is it that retail in particular has been so hungry for a higher yielding type of opportunities?
I have a cynical answer and I have maybe a market answer, right? I mean, before 2 years ago, right, it was very obvious that we were in a zero rate environment. Assets were not providing, they're providing capital returns, but not enough yield. And, in some ways, yield is pretty important, especially we do have a large population of boomers and people who are already in retirement and who are going into retirement. Whereas price appreciation is not as important as stability of income generation to supplement their income or to be their income. So even at a higher rate environment now at 4.25, that stability of income is still very important for a lot of investors. And especially since most of the instruments that we see that generates income either in the form of dividends or interest payments and bonds, those are fixed. And so when inflation is higher, that actually eats into your ability to have, to keep the real parity on the cash flow that you get. So I think that, despite not being in a zero rate environment, I think that is still very on top of mind for both advisors and their clients to be able to find sources of very consistent and periodical income.